Have you ever noticed how many people pride themselves on being good with money and still don't seem to get ahead? They pay their bills, keep their credit cards under control, and track every expense, but somehow wealth always feels out of reach. Being careful with money isn't the same as building it, and that's a distinction most of us never fully grasp. Take a familiar scenario. Imagine someone earning $4,500 a month after taxes. That feels comfortable for a single person or a young couple just starting out. Out of that, $1,200 goes to rent, $400 toward a car loan, $200 toward student debt, and another $100 toward minimum credit card payments. Add in everyday spending, dinners, subscriptions, weekend trips, and suddenly $1,000 disappears almost automatically. By the end of the month, there might be a small leftover, maybe $200. It feels like progress, but in reality, it's barely scratching the surface of long-term financial growth. Let's break this down with simple math. Saving $200 a month adds up to $2,400 a year. Over 10 years, that's $24,000. On paper, that sounds reasonable, but when you factor in inflation, lifestyle creep, and the lost opportunity to invest that money in something that grows, the real impact is far smaller than it looks. A decade of careful budgeting can leave you financially stable, but not wealthy. Why does this happen? Part of it is psychological. Paying bills on time and avoiding obvious debt creates a sense of accomplishment. Tracking expenses makes people feel in control. These are small, tangible victories that the brain rewards with satisfaction. But this sense of control can be misleading. Feeling financially responsible isn't the same as actually increasing net worth or creating options for the future. Over the long term, this approach has consequences. If someone continues this pattern for 20 years without intentionally directing resources toward investments or growth, they may look back and realize they've spent decades being careful but not building wealth. Their income has grown, but so has their spending. Their savings have increased, but mostly in cash, not in assets that appreciate. The subtle mistake is confusing stability with growth. Financially intelligent people approach money differently. They still manage their spending and avoid unnecessary debt, but they think about the future first. They prioritize allocating resources into investments, understanding compound growth, and leveraging systems like employer-matched retirement plans or low-cost index funds. The goal isn't to micromanage every coffee or dinner, but to ensure that their money is working for them over time, quietly and consistently. The mindset shift is subtle but significant. Wealth isn't about controlling every expense or never enjoying yourself. It's about directing resources strategically, understanding where money can grow faster than inflation, and making choices that create options in the long run. It's not flashy or glamorous. It's patient, unemotional, and consistent. So being good with money is a solid foundation, but it's not the end point. Discipline alone doesn't create wealth. True financial progress comes from pairing responsibility with strategy, patience, and a clear understanding of how money can grow when it's allocated thoughtfully. By shifting focus from feeling in control to actually building value, the small daily decisions start to add up in ways that matter decades later. If this perspective made you rethink how you approach your own finances, consider subscribing. Understanding money clearly, without hype or false promises, is often the first step toward making it work for you.